Welcome. Moss Adams is pleased that you joined us for today's webcast, 2023 Private Equity Funds Update. Before we begin, I'm going to play our housekeeping video.
Welcome, and thanks for joining. We're pleased to present our continuing professional education webcast series. Before we begin, please keep the following in mind. You can customize how you view our presentation and interact with the presenter. For better viewing, close all other applications and turn up your speaker volume. You can adjust window size and placement or enter full screen mode using the controls at the top right of the window or dragging the bottom right-hand corner to resize. At the bottom of your screen, you'll see a series of icons that relate to a different aspect of our session. You can download a PDF of today's slides from the Slide Deck and Handouts widget. You can ask questions by typing in the Q&A window and clicking Submit. We'll do our best to answer all questions or follow up via email. If you experience technical difficulty, refresh your browser by hitting the F5 key. Today's session offers 1 CPE credit. To receive credit, you must meet the National Association of State Boards of Accountancy requirements. You must attend at least 50 minutes of the session and respond to at least 75% of polling questions. To participate in the polls, please check the button next to your answer within the slide window and click Submit. We'll track your progress and alert you when you've earned CPE credit. You can then click the certificate icon in the CPE Progress widget and download your CPE certificate. Don't worry if you can't download your CPE certificate today. We'll email you a copy in 2 weeks. If attending this webcast in a group, you must complete our group CPE attendance sheet, available in our Slide Deck and Handouts widget to receive credit. Please have all group members sign it and send only 1 sheet per group. CPE credit can only be awarded to participants registered as themselves and isn't available for participants who view the on-demand version. This presentation is not legal, investment, or accounting advice. We encourage you to seek the counsel of a professional service provider to apply this content to your specific circumstances.
And now I will turn it over to today's presenters to get us started.
Thank you, Lauren. Good morning, everyone. Good afternoon. My name is Syed. I'm an audit partner in our private equity venture capital asset management practice. I want to welcome you to our 2023 Private Equity Funds Update. We have quite a packed agenda today, so I'll briefly go over the agenda and introduce you to our presenters. If you do have questions, please feel to add them in the chat box. I will be monitoring the questions and redirect them to our speakers as they come in. We'll be kicking off our update with the 2023 Private Equity Funds Update and Outlook by Sterling Smith. Followed that will be our carried interest valuation discussion presented by Diego. After that, we will dive into our regulatory updates impacting private funds. That will be presented by Ahat. And we'll close our presentation with a tax update presented by Jason and Key. As a reminder, if you have any questions, please type them in the Q&A chat box that you have on the bottom right of your screen. I will be monitoring the questions and bring them up to the presenters as during the presentation. Or if we don't get to your question, we'll definitely answer them after the presentation. With that, I will hand it over to Sterling to kick us off with our private equity update. Sterling. Sterling, if you're on mute.
Thanks, Syed. Sorry about that, group. So my name is Sterling Smith. I'm a director in Moss Adams. I primarily focus on private equity and work with investment banks. Again, spend most of my time in conversations with many of your peers and look forward to giving you an overview today. Before I jump in, I think we're going to kick off here with the first polling question.
Great. Thanks, Sterling. Polling question number 1. Which debt markets have grown significantly in 2023? A, bank debt. B, leveraged loans. C, private debt. The polling questions are located right on the slide we're presenting. If you can't see it, you can hit the F5 key to refresh your console. To respond, please click the button next to the answer you choose and hit submit. Also, like Syed had mentioned, you do have the option to submit questions for the presenters in the Q&A window. We do have quite a bit of content to cover today, so if we don't have time to respond during the webcast, we will do our best to follow up with you afterwards. And we'll give you all a few more seconds here to respond. And please remember to hit submit so your answer counts towards your CPE credit. All right, and here are the results.
Okay.
Back to you, Sterling.
Thank you. So I'm glad that looked like the majority of the group had identified private debt, which is the correct answer. And, there's a couple trends that are pushing that I think I'd like to share and expand on. One, private debt, if you look at the market, it's probably 1.5 trillion plus and growing in terms of available capital. And that capital is, again, private debt. So these are managed funds, non-bank related debt fund vehicles. And interesting with the private debt that there's been sponsor finance vehicles for many, many years, as well as direct lending. But the direct lending vehicles have been the one that have garnered the most attention. A lot of that being driven by a higher rate interest environment and LPs focus on looking at returns that are a little more guaranteed, a little more visibility. And, when you place debt, you kind of have a term on it versus, in a traditional private equity vehicle, you may have to, wait 7-10 years for, an exit to monetize, that LP capital investment. In terms of, the 2023 year, I assume most of the folks on this phone call have experienced this in their own jobs and witnessed that 2021 generated a very active M&A environment. You look at the different research and groups that track data, it really runs into the most active period that we had seen. And a lot of that drove that was, valuations were at all-time highs, which attracted more and more sellers into the market, easier credit terms, cheaper debt capital. Again, it was a much different environment, just 2 years ago, if you will, than definitely what we've experienced this calendar year. 2022 benefited from 2021 deals that just couldn't get done by the end of 2021, rolled over to the first quarter. A lot of that was being driven by private equity groups just not being in a position to close deals because they couldn't get through diligence. Again, we experienced that here at Moss Adams in our own transaction advisory practice. Bandwidth was just tapped throughout the back half of 2021. And we really didn't see an ease up into that till probably 4th, 5th month into 2022. In 2023, much different environment. Deal values down probably 40% off of 2022, which was down even from 2021. What's interesting though is that there's been a pickup, and I wouldn't say pickup, but there's definitely been more activity that's not reflected in what I call total aggregate deal value. And a lot of that being that smaller deals are being done, platform add-ons, bolt-ons. We've seen a lot more of that transpire in the deal markets in 2023. Other factors that have really dampened, if you will, the 2023 deal-making environment, real inflation, the corresponding impact that the Fed has had through their fight against inflation. There are a lot of pundits out there that are pointing toward or claiming that, we could have a recession, this year, next year, second half of next year. Again, I think the crystal balls are fuzzy for many of the folks in the investment community, but there's still concern around, the health of the American consumer, particularly when you think about student debt loans having to start repayment, which just recently occurred. Generally, there's been a lack of platform investment opportunities. Again, standalone companies that are brought to market either by private owners or even private equity-backed companies. Definitely talked to a lot of folks in the private equity investment side of the house that have been very cautious about selling performing companies. And again, a lot of this comes down to valuation and structure implications in this current environment, which I'll talk to on the next slide. And with that, I'll just skip over. So, wait, I got to. Okay. So, again, in 2023, with a let's say lackluster M&A environment, when I speak with a lot of my prospects and clients, what we're seeing as indicated on this page are, kind of 6 major concerns that lead many to say that we don't see deal activity really picking up till, end of 2024, which when you're in the business of investing capital for your LPs, it's a little tough pill to swallow, but I think many of the folks I talk to may be directionally correct. So it's not lost on folks that the interest rate environment is challenging. The Fed keeps posturing for higher for longer. I don't think the inflation battle is won. I think we still have, a ways to go before we get core CPI under control. And again, we're just having to kind of wade through the consumer and, when has the Fed done enough to really calm the consumption patterns. Availability of debt, like I mentioned earlier, there's a lot more funding going into alternative lending sources, and again, that's being non-banked. So I think availability of capital is less the issue today, but the cost of debt capital has really been a drain. So overall, most people I'm visiting with, they just kind of accept it. If it costs higher, and from a debt capital perspective, it may have implications on returns, but capital needs to be put to work, and there are deals, not as many, but some certain amount of deals that still need to be completed just based on needs of selling institutions or selling founders, owners. Quality of investments, hear about this a lot. It's, you get into the alphabet soup of classifications, but A, inventory is just not prevalent in the market. And that's just having just a general global effect on private equity, that it's not that they're not chasing deals. It's just once they get into due diligence, they're finding that there's a lot more story than maybe being presented by investment advisors. In terms of exits, probably not lost on folks that 2021 was a record IPO year, and that did not carry through to 2022. IPO activity, capital raising is just in the public markets on the equity side was down roughly 90% from 21 to 22. And then 2023 has been more the same in terms of 2022 observations. It's been lackluster. Public market valuations have been down. We had a run up kind of in the middle of the year, but now we're kind of trending down recently. Public markets obviously fall into the analysis when people are trying to value businesses when they're considering their own exits. So I think with the IPO markets and just capital markets in general pseudo shut, that's going to continue to drag on VC returns and keep a number of private equity backed companies from going to market. Valuations, it's interesting. They seem to be a little sticky from what I hear. And it's a challenge because you had sellers who were selling in the vibrant 2023, talking to their peers who are considering selling, and the current group of sellers really kind of look out and say, well, why can't I get what you got for your business? And it's just not a reality to consider the prior, call it heydays of 2021 as your bogey. So we're going to have to see how that plays out, as I think sellers are starting to get a little more tempered on their expectations. And the last point, there's always some uncertainty in an election year. So I'm not really sure how that'll play out this cycle, but given the chaos we're seeing in our current political landscape, I would expect that's going to temper some deal-making activity, just 'cause it's hard to underwrite that risk. Okay, I touched on valuations, and I think the main takeaway is less opportunities to chase quality deals because there's just not that many in the market. Those that are in the market have been going at what I'd call premium valuations. Again, it's just less to be had there. 2023, as I referenced earlier, it's the year of the add-ons. So we are seeing a lot of smaller deals getting done. Those can tend to be done with lower valuations, can be done through debt, which is just helping the private equity groups amass larger businesses. And again, there's also another theme of many companies have been consolidated in the last couple of years, and now traditional managers are stepping back and spending more time on operational improvement and integrating this amalgamation of companies that they pulled together to just increase value through operational efficiencies versus financial gearing. And then one of the most notable things that I've picked up on in various discussions is the amount of structuring that has been involved in deals. And really, I mean, you pay cash, you put debt on the business, but then the three other components that the sellers get involved in is the rolled equity, seller financing, and earnouts. I was an investment banker for 15 years, and earnouts were kind of a no-no. You never wanted to have your client, when you were selling or advising on a sell, to be in a position where they had earnout. In this realm where we see ourselves in today, earnouts are very typical. In fact, all three of these we're seeing in deal structures, which is not really a seller-friendly environment from that perspective. But that's how deals are getting done, with being able to offer up valuation, at least on paper, that gets sellers to commit to closing the process. Okay. So I'll wrap up here with just a few comments on what I'll really refer to as kind of a new world that private equity managers are operating in. I mean, it goes without saying that higher cost of debt may potentially lower return levels from historical experience. Again, higher cost of capital is going to affect the cash-on-cash returns and IRRs generated after fees to the LPs. And I've been to a number of conferences in the last couple of months, and there's definitely expectations from the LPs that the returns that they've experienced over the last 10 years will face some compression, some from higher debt costs, some also just from the competitive landscape, because there's just so much money floating out there in terms of dry powder. Talked about direct lending a couple times, definitely seeing more competition from the private equity, where companies that decide to raise debt capital versus taking on the equity dilution. Really, it's just kind of kicking the can down the road. The expectation is that they will sell eventually, but they want to try to, maintain as much of the equity stake prior to a transaction. There's a proliferation of independent sponsors, and these are individuals who, go out and seek deals, very similar to what traditional fund managers are doing, but there's many more independent sponsors than I can ever recall in the M&A climate or environment. And I would say that it's not unusual for traditional fund managers to partnering with an independent sponsor, just as it's difficult to find, good quality deals to invest in today. Tough fundraising environment. Seasoned managers are receiving disproportionate amount of the funds. These are brands that have been around for a long time, the KKRs, the Blackstones. And then a first generation or vintage fund or even a second fund are having a lot of troubles raising capital, extended time frame, a lot of anxiety in the GPs who are out there trying to amass their capital commitments. LPs pushing for more transparency. I think they would like to have lower fees on new commitments. I'm not sure I'm seeing that play out in the market, but there's definitely more pushback from LPs now than I think there has been historically. And then again, this is a water down to the GPs, but a lot of LPs are being squeezed on many fronts. Lower public valuations. You have capital not coming back because exits are not happening. IPO market referenced before has been locked. So it was interesting listening to a large pension or large endowment speak at a conference, speaking to the fact that they called many of their GPs in the recent months, asking them not to call capital. So again, it is a new world for PE managers. Not one that can't be overcome, but maybe one that's a little bit of pain in the near term as we work through the current economic cycle. With that, I think I will turn it over to Diego to discuss carried interest valuations.
Yes, thank you, Sterling. Appreciate it. Hello, everyone. My name is Diego Aguirre Torres, and I'm a manager in the business valuation group here at Moss Adams. Our group handles business valuations for a number of purposes that include gifting, estate, and financial reporting. Donovan Trone, a director in our group, and I take on many of the carried interest valuations that come our team's way. And in addition to carried interest valuations, which are typically held by general partners, whom also tend to be the fund managers, we also value limited partner interests. Today, however, we will focus on carried interest valuations. So why don't we start by looking at the main considerations in this type of valuation? The first is how we intend to model out the carried interest. We will briefly go over 3 common methods that we use in this type of valuation. Now, the initial calculation will conclude on a carried interest value that is on a majority basis. In other words, the value of what a non-controlling shareholder would receive upon a transfer. Second, we will go over minority and illiquidity discounts. After applying these discounts to our majority basis carried interest value, we will ultimately be concluding on a value that is on a minority, non-marketable basis. In other words, the value of what a non-controlling interest shareholder would receive in a transfer. And this is typical in a transfer or gifting situation. Lastly, we will touch on certain relevant tax topics as it relates to carried interest. Now, before moving on to the next slide, I would like to point out that there will be key pieces of information that we require in evaluation that will help us shape and guide us to the most common sense approach. Those pieces of information are fund and related party structure diagrams, fund, general partner, limited partner agreements, and audited financials. So modeling out the future carried interest. So there are 3 common methods we consider in modeling out the carried interest. They are the DCF, the derivative, a Monte Carlo simulation method. A DCF, or discounted cash flow method, will begin with the state of the fund as of our date of value. We will then model out the cash flows to the end term of the fund. Our cash flow model will take shape as we assess the level of committed capital, capital already deployed, and future capital that will be deployed. We will also consider management fees, expected returns, and discount rates to arrive at a present value of the carried interest cash flows. As noted on the slides, it is the easiest method to understand because the cash flows can be traced or followed, but perhaps is the most subjective. Now, the next method is the derivative method that treats the carried interest value as a call option. Now, there's less subjectivity from the standpoint that we are not modeling out several years of cash flows as we do in the DCF method, but there are, however, assumptions that need to be considered, such as volatility or time to exit. This method is also less customizable, which makes it trickier to incorporate multiple scenarios or situations. Now, the math behind this method is based on the Black-Scholes option pricing model, which I will not go over because I've been told it's the quickest way to have people log off the webcast. Now, the final method is a Monte Carlo simulation method. This method can be based off two previously mentioned methods, but incorporates a statistical framework. This method is particularly useful when modeling several scenarios, but it can lead to overcomplicating what may be a more straightforward situation. Now we'll go ahead to the, I believe it's a polling question that is next.
Yep. Thanks, Diego. Polling question number 2. Which is not a model that can be used to determine the present value of future carried interest? A, discounted cash flow. B, option pricing model. C, Model Y. D, Monte Carlo. And as a reminder, if you would like to receive CPE credit for today's webcast, you will need to respond to at least 3 of the 4 polling questions. Also, if you would like to submit a question for our presenters, please do so through the Q&A window. We'll try our best to get to it during this webcast, or we'll follow up with you after the presentation. I'll give you all a few more seconds here to respond. And please remember to hit submit to submit your answer. All right, and here are the results. Back to you, Diego.
All right. Thanks, Lauren. Okay, so we'll continue here. As previously mentioned, we will apply appropriate discounts to the carried interest value in a transfer of a minority closely held interest. Here, we will cover the discount for lack of marketability, or DLOM for short. Now, in a valuation context, a DLOM is applied because no market exists for minority interest in closely held entities. In other words, the interest is illiquid. And this is part of the fair market value standard as defined in ASC 820. And this is also in contrast to, say, the stock market, which is an active marketplace where you can purchase shares of publicly traded companies. As such, those shares of these publicly traded companies are deemed liquid. Now, the magnitude of the DLOM discount will depend on a variety of factors that include, but are not limited to, agreement provisions that may impact the specific interest being valued, remaining life of the fund, distribution history, and the exit environment. Now, in order to form a DLOM discount, we rely on certain widely accepted studies to first form a benchmark, and we can also incorporate other methods to calculate a DLOM. The final discount we will cover is a discount for lack of control, or DLOC. So typically, a minority shareholder will not have the same rights as that of a majority shareholder. Those rights can include, but again, are not limited to, the timing of distributions to shareholders, managing the fund or selecting managers to manage the fund, or other attributes that may have an impact on value. Similarly to the DLOM, we rely on certain widely accepted studies to first form a benchmark, and we can also incorporate other accepted methods to calculate a DLOC. As noted earlier, we will get a lot of direction from the various agreements that we request in the initial stage of the valuation. That will help us assess the magnitude again of both the DLOM and DLOC discounts. Now lastly, here we'll cover some high-level tax characteristics and implications as it relates to carried interest. Currently, carried interest are taxed at the long-term capital gains rate, which is lower than the ordinary income tax rate. That is because they are structured to fall within the safe harbor provisions per the Revenue Procedure 93-27 issued by the IRS. I will not read the whole procedure, but it defines both the what are profit interest and capital interest. The determination of whether an interest is a capital interest or a profit interest is generally made at the time of the receipt of such interest, and evaluating liquidation value is significant in determining classification of interest on the date of receipt and its taxability. Next, from a valuation perspective, we consider unrealized gains or losses in the underlying investments. As such, the recharacterization of gain rules under IRC Section 1061, which states that first, carried interests fall under the definition of applicable partnership interests, or API, and subsequently, the lower rates apply to long-term capital gain from sale or exchanges of capital assets of partnerships should not be available to holders of API interests, unless extended 3-year holding period requirements are met. Lastly, fund managers should consider whether they can only give carried interest and not their ownership interest in the fund. IRC Section 2701 looks closely at the value interest retained by the transferor in transfers involving partnerships and corporations with multiple classes of ownership interest. Therefore, due to implications of IRC Section 2701, in addition to the carried interest actually being transferred, the IRS may potentially consider some portion of retained ownership interest as a deemed gift as well. Now, this concludes the presentation on carried interest valuations. Hope everyone had a chance to sing out the lyrics if you know the song there on the slide. And now I will turn it over to Ahat Nabiev. Thank you.
Thank you, Diego. Very helpful, appreciate it. Now we're going to dive into regulatory update. And if you move the slide, please, Lauren. The next one, please. Thank you. So we have 4 items on the agenda today, and many of you probably have seen these. All of these were circulated via social media and LinkedIn. You're aware, but this is just to give you an update as to where things are with the SEC regulatory updates. First item on the agenda here is SEC release exam priorities for registered investment advisors or broker-dealers. This release was took place in February. The next item is the proposal. SEC proposed enhanced safeguarding rules for registered investment advisors. This proposal is still open for comments. I think it's open until end of October, and then there's more to come on this one. And then the third item we're going to talk about is SEC enhances the regulation of private fund advisors, which was adopted already, and we'll discuss the adoption dates and effective dates. And the last item on the agenda for today is SEC adoption of amendments to fund names rule. which was also adopted. And we'll talk about it a little more today. If you can move to the next slide, please. Okay, we have a polling question here.
Great. Thank you, Ahat. Polling question number 3. How well prepared is your fund to implement the recent SEC adopted and proposed rules impacting private funds? A, fully prepared. B, somewhat prepared. C, prepared, not prepared. D, proposed rules not applicable. If you have any issues viewing this slide, please hit F5 or Command R on your Mac computer. As a reminder, if you would like to receive CPE credit for today's webcast, you will need to respond to at least 3 of the 4 polling questions. For those who would like a copy of today's slides, you can download them from the folder that says Slide Deck and Handouts. We will also be sending them out via email tomorrow, along with a recording of the webcast. And we'll give you all a few more seconds. Please hit Submit to submit your answer for CPE credit. All right, and here are the results.
All right, it looks like majority is somewhat prepared, which is good. Like I mentioned, these updates have been circulating around, and some people are already prepared. But for those who are not prepared, hopefully this update will help and provide some useful information. Next slide. All right, the first item on the agenda, the exempt priorities released by the SEC. Exempt priorities and focus on this year will be conflict of interest, calculation and allocation of fees and expenses, including management fees, compliance with the marketing rule, policies and practices regarding use of alternative data and compliance with Advisor Act rule, custody rule. With the exception of the focus on the new marketing rule, the other areas of priority are not new, and RIAs should already have policies, procedures, training, and other compliance tools in place to address them. The new marketing rule here is the new item of focus. This rule was adopted in December of 2020 and went into effect in November of 2022. Exam will assess whether RIAs have adopted and implemented written procedures and policies that are designed to prevent violations of the marketing rule by RIAs. The requirement that RIAs have a reasonable basis for believing they will be able to substantiate material statements of fact and requirements for performance advertising, testimonials, endorsements, third-party ratings, etc. And the RIAs should confirm that their compliance manuals and training programs cover the marketing rule, review all marketing materials that they currently use, even if prepared before the effective date of the new rule, to confirm that they comply with the new requirements of this rule. Confirm that their client referral and placement agent relationships comply with the requirements of this new rule as well. All right, next slide, please. Rules impacting duly registered broker-dealers and RIAs will mostly focus on investment advice and recommendations, disclosures made to investors, best interest evaluation, including conflict of interest and fiduciary duty, investment goals, and account characteristics. And some other focus areas will be environmental, social, and governance investing, ESG investing, fintech, crypto assets, etc. Next slide. The item number 2 on the agenda is a proposal enhancing safeguarding rule for registered investment advisors. As I mentioned, this is still open for comments, and we'll focus on expanding the current custody rule to protect a broader array of client assets and advisory activities to the rule's protection, and to enhance the custodial protection that client assets receive under the rule, and to update related record keeping and reporting requirements for advisors. As I mentioned, there's more to come on this. Next slide. The item number 3 on the agenda is about the enhancement of regulation of private fund advisors. The SEC adopted new rules and amendments designed to increase transparency and protect investors in private funds. This was adopted in August of 2023. The new rules require private fund advisors registered with the SEC to provide investors with quarterly statements detailing information regarding private fund performance fees and expenses. This rule will be effective 18 months after publication for registered investment advisors with assets with 1.5 billion in assets under management. The next rule is obtain annual audit for each private fund. That will be a requirement to have the SEC registered advisor to manage private funds to be audited annually. Effective date is 18 months also, similar to the quarterly statement requirements for RIAs with 1.5 billion in assets under management. And then the obtain a fairness opinion or valuation opinion in connection with the advisor-led secondary transaction. Some of our clients already doing this and engaging the third-party valuation specialist to do the valuation of these transactions. Typically, when the company is doing great but the advisor believes it will continue to grow and increase in value, so they launch a new continuation fund and sell it to that fund. And effective date for this rule is for smaller RIAs, which is advisors managing funds of 1.5 billion, less than 1.5 billion, will be 18 months after publication. And then there's a new rules required that all private fund advisors, including non-RIAs, meaning non-registered investment advisors. The first one is not engage in certain activities and practices that are contrary to the public interest and the protection of investors, unless they provide certain disclosure to investors and, in some cases, receive investor consent. And then the other one is not provide certain types of preferential treatment that have a material negative effect on other investors, and prohibit other type of preferential treatment unless disclosed to current and prospective investors. These practices include certain pro rata fee and expense allocations, reduction of advisor clawbacks for taxes, certain regulatory compliance, examination and investigation fees and expenses, and borrowing and receiving an extension of credit from a client. The rule restricts all private fund advisors, including those that are not RIA, SEC registered RIAs, from engaging in certain activities and practices, regardless of whether their fund governing documents allow for such activities, unless they satisfy the specific disclosure requirement. There's a legacy status where the SEC is providing legacy status for the prohibition aspect of preferential treatment rule, and the aspect of the restricted activities rule require investor consent. The legacy status provisions apply to governing agreements that were entered into before the compliance date. All right. names rule. Fund names rule. The last item on the agenda is the SEC adopting amendments to fund names rule. The SEC adopted amendments to Rule 35D-1 under the Investment Company Act of 1940, the fund names rule. The amendments will better serve the SEC mission of investor protection by improving and broadening the scope of funds that must comply with the current environment to adopt a policy to invest at least 80% of their assets in accordance with the investment focus the fund's name suggests, providing enhanced disclosure and reporting requirement related to terms used in fund names, and establishing additional record-keeping requirements. This rule is effective 60 days after the publication. For fund groups with net asset of $1 billion or more, they'll have 24 months to comply with the amendments. And for fund groups with net assets of less than $1 billion, will have 30 months to comply. The SEC enhanced rule just to prevent misleading or deceptive fund names. The names rule currently require that funds with names suggesting investment in particular type of investment, industry, country, or geographic region adopt a policy to invest under normal circumstances at least 80% of their respective assets. The SEC will now require a fund to adopt an 80% rule if its name suggests the investment focus, including examples such as growth, value, and terms indicating that the fund's investment decisions incorporate one or more ESG factors. Require for funds mostly focusing on anything that impacts the name of the fund. So that's the last item on the agenda for me today. And now I turn over to Jason and T for tax update.
Thank you, Ahat. Appreciate that. Well, we've saved the best part for last, taxes, which I'm sure everyone's been on the edge of their seat waiting for that update. So here we go. We will try to get through it here before the 11 o'clock hour is up. So before we talk about some of these changes on this first slide here, I did want to sort of touch on a few of the things that we talked about last year, which, were important ideas then, continue to be important ideas now. Last year we saw the Inflation Reduction Act have provisions in it right up until about 11 days before it was signed that looked to weaken the carried interest benefits, in effect, broaden some of the restrictions that IRC 1061 put into place back with the Tax Cuts and Jobs Act several years ago now. So we got through the Inflation Reduction Act without any law changing 1061. But I think it's important that everyone's mindful that this is still, a bargaining chip as we look to future legislation. It's likely to be curtailed. It's always a hot topic. And so, just because we've gotten through 23 without hearing much about it doesn't mean it can't pop back up. And the same thing goes for qualified small business stock, referred to as 1202 stock. That's 100% exception right now federally and in most states. The federal rules have been in place for about a dozen years now for that 100% preference. Again, that has always been a hot topic in recent years as a bargaining chip to either strip that back to 50% or something less. So again, be mindful of those things. Those could be things that we have to battle and deal with in the coming years. Focusing on this slide here specifically, we talk about Section 163J. That too was a Tax Cuts and Jobs Act limitation on interest deductions, yet another threshold to get over for deducting interest. More of a portfolio company level issue as opposed to, say, a fund issue. But important to be mindful of that if you're getting a K1 from a portfolio company that's set up as a pass-through. You could see increased disallowed business interest expense. You may have seen it in 22. The key issue there being is that starting in 22, the computation of the base by which you calculate your limited interest no longer allowed depreciation and amortization to be factored in, which, for more asset intensive companies is a significant change. And so we've seen between that and the combination of rising interest rates, significant increases in the deferral of interest expense that comes from a lot of companies. So that's important to be mindful of. Other changes we see here on the slide, we talk about California tax basis reporting rules. At the federal level, we've had to do that since 2020. California has sort of continued to kick the can down the road. If you've got it for California or federal purposes, many people have been disclosing as such on the California K-1s. California came out early in 23 and basically said that for the 21 and 22 years, you could continue to use another acceptable method. So that will sit out there until the 23 tax year, for the 24 filing season coming up soon. Other items on this slide I want to briefly touch on is the IRS's continued emphasis on self-employment tax and its applicability to limited partners and partnerships. It's been a significant issue with the IRS for several years, and they continue to look very closely at the nature of limited partners and their activities in a partnership. And this is really bubbling up with certain hedge funds and other folks in the venture capital private equity space. There's currently some tax court petitions out there regarding IRS assessments where they've come in and looked at the activities of limited partners who are being treated as such and therefore not subject to self-employment on their allocable share of income from the partnership. And the IRS disagreed and has had some rather significant assessments on self-employment tax. So I think it's important to be mindful of that. True limited partners from the IRS's perspective are silent partners that have nothing to do with running the day-to-day operations of the fund or the management company or whatever it might be. So just a hot topic there with the IRS, and we're going to see more coming from the U.S. tax court on this soon, I think. Another thing you may have heard about has to do with foreign ownership registration, and it's really any ownership registration, really. The Corporate Transparency Act is effective January 1st, 2024. It's a FinCEN reporting thing that you're going to have to deal with basically starting in 24. FinCEN might be familiar to some of you. It's the Financial Crimes Enforcement Network. Some of you may have been filing the FBAR, foreign bank account reporting under FinCEN guidance. This is more rules promulgated by them, where basically you're going to have to report beneficial ownership in really any U.S. business, absent meeting an accepted or a list of exceptions for certain businesses that don't have to do this. But it's not just looking to foreign ownership; it's looking to all ownership. And so businesses, in theory, businesses that exist prior to January 1st, 2024, they will have 1 year to comply with these rules and report their beneficial ownership information to FinCEN. Otherwise, if it's a newly formed entity, let's say you form a new fund sometime in 24, you've got currently, at least as the rules are written, 30 days to get that information reported to FinCEN. So there's some talk about that being extended to 90, but there's a lot of information out there to be mindful of as we look at the 24 and those ownership rule changes. Quickly running through these last final slides here, I just wanted to touch on the BBA audit process. What is that, you might ask? BBA stands for the Bipartisan Budget Act of 2015, became effective for tax years ending after 2017. What does it mean? It basically just deals with the how the IRS audits a partnership and goes through that process. So, the short answer is we've learned over the last few years that it's pretty burdensome, very slow, and can be very challenging to work through. So a lot of times we may recommend that partnerships elect out of the centralized audit regime, CAR, which a lot of you might see forms each year as your tax returns are prepared to elect out or elect in to that regime. So, the key point there is it may be advisable to elect out. There may be reasons to elect in, just something to discuss with your tax preparer. But, a lot of times funds, simply because there's LLCs invested or more than 100 K1s, simply cannot elect out. And so you're automatically in the program. And so if there's an audit, then you have to partake in that process. And again, it can be arduous and more difficult than audits of partnerships were historically. It's supposed to be easier. It's supposed to be more easier for the IRS to deal with changes that may come out of the audit. The biggest thing is it gives the partnership the opportunity to basically settle any tax liabilities at the partnership level rather than pushing them out, which may be a good thing. Just depends on the circumstances. But again, it's a rather challenging process. So we generally encourage people to consider electing out if possible. The biggest problem I see is that if you cannot elect out of this audit regime, if you need to amend a return, if someone comes to you and says, hey, my EIN should have been different or whatever, there was a transfer that got missed during the year, you can no longer just amend a return under this audit regime. You have to go through this process to simply update an EIN or something like that, which is extremely arduous, can be very costly. So it takes very simple things like that and makes it where you have to go through this process. And typically it can be several $1,000s of work just to go through the hoops that you need to do that. Let's see, 1056, we're going to skip through that one. I want to touch real quickly on state pass-through entity elections. This is a fun multicolored map. It's a little out of date at this point, but it talks to, the Tax Cuts and Jobs Act limited the state and local tax deduction for individuals on Schedule A as an itemized deduction. So it took away, basically put a cap, $10,000, the SALT cap. The states have come along, they've put these pass-through entity tax elections in place to allow folks to basically get a deduction on the business return. So the K-1 ordinary income has, in effect, a reduction for state taxes that prior to all of this wasn't available. The key takeaways here, I think, is that the timing can be very tricky. California, you've got very limited timing to which to do this. If you didn't have a prior year election in place, you've got to pay in $1,000 typically by June 15th of each year. If you had a prior year election in place, you have to pay in 50% of the prior year tax by June 15th. So, and California has not been friendly. If you have a footfall, don't attach an election, they are generally very unforgiving. So it's important to make sure you get ahead of these in different states and make those elections where applicable. With that, I will turn it over to Key real quick for a quick update on K2 and K3.
We're running short on time, so I'm not gonna elaborate on the specifics. Just there are some changes going on Schedule K to K3 still, and there are more instructions coming out. So it's important to have discussions with your tax advisors about whether you are reporting all the necessary information and whether you are understanding what's reported on K2, K3. We have seen increasing amount of questions raised by the ILPs when they receive the forms, because there are a lot of information that's not applicable to them. So this is just bringing it up so that discuss this with your tax advisor so you got all the topics covered. I'm gonna move to the polling question. So everybody get their CPE credit.
Oh, thank you, Key. The final polling question, number 4, are you considering 2023 state PTET election for GP entities and or management co? Once you have completed all CPE requirements, you'll be able to download a PDF of your certificate for the CPE progress window. And give everyone a few seconds to respond. Please hit submit once you have chosen your answer. And as a reminder, there's a copy of today's slide in the slide deck and handout folder, but we will be sending it out tomorrow along with recording of the webcast. And here are the results.
Awesome. I'm glad everybody has made their payments in time. I will give it to Syed to do the closing statement.
Thank you, Key. Thank you, Jason. I would like to thank all our presenters. We are at the top of the hour, so we're running a little short on some of our closing remarks. So I would like to thank everyone for joining us. We have our investment conference coming up in December, so I suggest everyone look out for the invitation. A lot of the stuff we discussed in this update, we will discuss it again, and some other matters during our conference in December. With that, Lauren, I will hand it over to you for the closing remarks.
Awesome. Well, thank you to all our presenters for a great presentation today. Again, if you met all CPE requirements, your certificate is available to download now in the CPE progress window. A copy will be emailed within 2 weeks if you have any difficulty downloading it now. And finally, here is a link to the survey for today's presentation. Your feedback is appreciated. Thank you, everyone, for joining us today. Take care.